good evening, whenever you're watching this. This is actually the second time I've recorded this. The first time I spent half an hour doing it and I never shared my screen. So it was me talking to that little avatar of myself. What a waste of time. Okay, so I'm doing it again. Okay, I hope you're all well. This is the second revision session based on calculations. As I mentioned last time, I'm just going to go over some basics, the basic calculations, mainly identified from the in-class mock. So last revision session, we looked at break even and revenue. Today, we looked at total revenue and costs, that sort of thing of it, profits. And today we're going to look at break even and margin of safety. So same thing last time. I'm going to remind you with a few slides, and then we're going to work through some of the answers of some questions. Now, hopefully you've got access to the set of questions beforehand, so you might have already had a go. Okay, right. So let's start off and go up to the PowerPoint, and we're going to look at break even and margin of safety. Okay, so these are statements from the exam board from Edexcel. What you need to do is understand the concept and calculation of break-even level of output and margin of safety, and also interpret these break-even diagrams. The things we probably won't look at today is the impact of changes in revenue and costs. Okay, everything else we should be able to cover. Okay, so break-even, what this is basically the point at which you as a business are no longer making a loss. Okay, so it's the minimum number of units or sales or output which needs to be produced or sold in order to cover your total costs. So basically you're making the same amount of money, your costs are the same as your income, okay, as your sales. Okay, why is it useful? Well, let's say you want to borrow some money from a bank in order to start your business, and you want to go to them for a loan, and so you do a business plan, and you'll say, okay, well, we predict our break-even level of output is going to be 1,000 units. Okay, so if we sell 1,000, at which point we will be making money. Okay, so let's get straight into it. So we've got a graph here. On the y-axis is our revenue and costs. So on this one axis, we can measure both things, you know, how much money we're making and also what our costs are. And that's normally in pounds or whatever currency you're using. Across the bottom is our outputs. So basically what you're producing or selling as a business. OK, I'll always use the example of shoes. I know my group are fed up with me using it, but we'll use it anyway. OK, last revision session, we looked at these lines. So here we've got our total costs, which start from there. Okay, they start. So if we don't produce any items, okay, or any shoes, it's still going to start from there. We've got a certain amount of costs. And let's see if you can remember why. Why do you think it starts there? Whereas total revenue, well, we can't make any money, okay, until we actually produce and sell some of our shoes. So that's why it starts here at 0. And then the more we make and sell, the more money we're going to make. Now, hopefully you should have remembered from last revision session is our total costs are our variable costs plus our fixed costs. So fixed costs would be there, and then the variable costs go up as we produce. So that's why our total costs start there and not start from the 0 axis. Okay, so that shows our revenue going up like that, nice and steep, and there is our costs going up like that. So our break-even output is the point at which those two lines cross. Okay, so at that point here, you can see our total costs are the same as our total revenue, and break-even output is always a measure of output of units or items, or it's never a measure of revenue or pounds or pence. That's not what you're looking for. Okay, so you can see it at this point. When we have output so many items or sold so many pairs of shoes, that is the point at which we break even. In other words, we're not making money, we're not losing money. It's absolutely 0. Okay, so using that as an example, everything in this area here is our loss, is how much money we're losing. So for example, let's say at this stage here, the amount of money we're losing is the difference between the total cost and the total revenue there. Okay, this means a loss is being made. Conversely, so on the other hand, this area here is your area of profit. Okay, and you can see your profit, as we worked at last lesson, is your revenue take away your total costs. So it's the difference between the two. So when your revenue is more than your total costs, you're going to make a profit. So if you were looking at interpreting this diagram, you would see that as the area of profit. Okay. Before we go into margin of safety, let's have a look at some of these questions and let's have a go. Okay, let's go back up. So there we go. So Neil and Sue, here we go. Question 3. Right then. So Neil and Sue produced the following break-even diagram showing the costs and revenue for their business. So this is taken from an exam paper. I'm pretty sure your exam paper will be in black and white as well. I don't think it'll be in colour. So it's really important you can actually identify the different lines here. Another reason they do it in black and white is for those people who might possibly be colourblind and difficult to see different colours. So what we've got here is, first of all, there you go. Our thick black line is our fixed costs. They stay the same regardless of how many pairs of shoes we produce. These are things like the rent for the building, it might be insurance, it might be like the manager's salaries. All of this stays the same. Okay, so that stays the same. Then our fixed grey line is our variable costs. So as we produce more of these items, or if we sell more, it's going to cost us more. Okay, so for example, electricity to produce the items. You might have to use more electricity the more you produce. It might be the leather, the raw materials required to make the shoes. Okay, so that there is our variable costs, and you put those together to make our total cost. So the dotted black line there, that is our total cost, and it goes up like that. Okay, and you see our total revenue. This is from our sales. You can see it goes up like this. Okay, so the more we sell, the more money we make. And you can see here, it's at a steeper incline than our variable costs. And what that indicates is you're selling them at a price more than it costs to make. Otherwise, you wouldn't have a gradient not quite that steep. Okay, so first of all, identify the total number of sales that Neil and Sue will need to break even. So remember, break even is a number of sales or units. So it's this point at which our total sales and our total revenue and our total costs cross. So that's the two dotted lines. So there's our total costs, and it crosses the line round about here. It's easier to see when it's printed out, but on a screen we can see at that point is our break-even point when they cross. Remember, you go down, you don't go across to your revenue and cost. It's a number of sales, so you go down. So the answer there is quite simply 200 sales, or you could class it as units. Okay, number of sales. That is typically, that's your answer. Okay, nice and easy. So break-even output is the point at which your total costs and total revenue cross on that diagram. Okay, so the next question, it says identify the profit made by meringue by shading the correct region of the graph. Okay, so you've got to colour in. So that's why you need a pencil in this exam. So if we go back to our PowerPoint, so we can see here anything to the right of the break-even or break-even output, there is our profit. So let's go back to my questions. So basically, I just need to colour in that bit. Now to do this on here, I'm just going to quickly draw a shape to fill in that bit. So it's there, to there, to there, to there. There we go. Let's fill it in blue. No, I don't like that border. No outline. There you go. No outline, please. There we go. So I've just shaded it in there. Reminder, that's why you bring a pencil. Okay, so done that bit. Is there any more break even? Let's keep on going. Here we go. There's another one. Okay. Oh, this is margin of safety. Okay, but we can see we've got a break even diagram. Look how this one, how the actual total costs. Actually, it's not a straight line. That means it changes, depending on, what the output is. Okay, let's go back to our PowerPoint and look at margin of safety. So what this is the difference between the actual number of your actual output, number of shoes sold, compared to your break-even output. Okay, so we got an example here. So we have our break-even output there, and then you could say our actual output is here. So let's say our break-even output in this particular example is 100. Okay, and what you actually find out is you sell 150. So that's our actual output. Okay, it is the difference between the two, these two numbers here, which is your margin of safety. So let's say your break even is 100, your actual output is 150. Your margin of safety is going to be 50 units or sales. Once again, it's not measured in pounds. It's not like a currency. Okay, it is a number of sales. Okay, so there we go. It's recorded as number of units of output. Margin of safety, difference between the actual numbers you sell or produce compared to your break-even output. Okay, we're not going to bother with changes. We're just going to go straight into an example. So this is quite an easy question, but it does require you to just read it carefully because it's easy to miss some key information. So figure 1 shows a break-even diagram for a business. Okay, so what we've got there is our revenue, a nice straight line, thick black line. We have our dotted line here, which is fixed costs. And then we have this line with the little circles on, I don't know what you call them, with little bits in between. And that's our total costs. So straight away, there's one thing missing from this. Okay, you don't need it for the question. Can you have a look? Can you guess what it is? It is, of course, the variable costs. Now, the variable costs, what it would do, it would go from 0, but it would run parallel to your total costs. But we don't need it for this question because we're looking at the the margin of safety, because it's saying, right, the business produces 400 units of output. Okay, so that is our actual output. Using the information in figure 1, it says calculate the margin of safety. Okay, so as we saw before, let's go back to our PowerPoint. The margin of safety is the difference between our actual outputs and our break-even output. So it's that, take away that. Let's go back. So margin of safety is equal to, oh, did that last time. Safety is equal to actual output, take away BEO, BSBO. So in this case, our actual output you can see is in the question. Now that's so a lot of people miss that bit out because they're too busy looking at our diagram rather than reading the question. So our actual output is 400. Our break even, if we look, is the point at which our revenue and total costs break path. So it's there. Okay. So remember, you go down. So it's 250 units. So 250. So quite simply, 400 take away 250 is 150 units. Okay, and that is margin of safety. Okay, have we got any more questions? You can see there, it gives you the space to put units. Right then, margin of safety. Let's go into cash flow. Now, there's quite a lot of information here, but I'm just going to keep it relatively simple. So cash is different to sales. Cash is actually physically the money the business has, okay? And you've got cash coming into the business, okay, and cash going out, your expenditure, okay? So cash inflows could be, obviously, first of all, the revenue you make from cash sales, as in you sell a pair of shoes, they pay on card, or they pay using credit card, or they pay using cash. That's absolutely fine. Another source of revenue could be share capital, money you get from selling shares in your business, or it could be some interest got in savings. All of this is basically of money of cash coming into the business. Okay, cash outflows is your expenditure. Okay, the money you have to spend. Okay, so for example, it could be on your raw materials. Okay, so in shoes could be leather, could be rubber, that sort of thing. It could be bills you're paying, it could be tax you have to pay, wages of the workers, okay, the money going out. Okay, but it tends to be worked on a monthly by monthly basis. So a common question you'll see is, can you calculate the net cash flow? We'll talk about gross and net and the difference between the two in year 11, but when it means net cash flow, it's basically your inflows take away your cash outflows. Okay, so your inflows take away your cash outflows. Let's go and look at an example. Okay, so here we got a shows the cash flow forecast for a small business. It says we've got to complete the table. Now there's a few terms in here which you might not necessarily be familiar with, or you're familiar with, but you might have missed it. The first word there is receipts. Okay, receipts. Now, receipts, what your understanding is, might be that bit of paper you get after you buy something from a shop. Okay, it's confirmation that you purchased something. A receipt in a business, basically your sales. Okay, the money you've sold, how much money you've made from selling stuff or selling your product or your service. Okay, so receipts in this case is an inflow. Okay, it's your total inflows. Okay, so what we're trying to, okay, our net cash flow, I'll tell you what I'll do, I'll just do August. Okay, raw materials. Okay, well, that's going to be an outflow. It's going to be a cost because you have to pay for it. And your fixed costs, okay, is stuff like, rent and that sort of thing, insurance. So you can see on this cash flow forecast, you can see our total payments here, 10,170, is actually your raw materials plus your fixed costs. Okay, what we need to work out is our net cash flow. So our net cash flow, as we know, is inflows take away outflows. In this case, our inflows are our total receipts for August, which is 17,400, and we take away our total payments, which is 10,170. And I've just got I can't bother to work it out because I've done it before. Which question is it? There we go. Answer is 7,230. Okay, and I'll write that one there. Okay. So for September, what we need to do now is to work out our total payments. Now, when I did the video before, I went through a completely stupidly complicated way of doing it. Okay, but it still worked out the same answer. So the key thing is there's more than one way of doing it. Well, this is quite simple. So our total payments for September is basically our raw materials plus our fixed costs. So I'm going to say total payments materials plus, let's put FC. So in which case it's going to be 9,340 plus 2,340, and that ends up with 11,680. Okay, because your total payments are there. Now, there is a way of checking it. Shall I show you? Yeah, I might as well, because you might find this complicated way a bit easier way of doing it. Another way we could have done this one here, our total payments. Okay, well, our total payments are our total outflows. That's the same as that. So what you could do is just rearrange this formula to work out our total payments. So I don't know if you've done it in maths or science, but if you can rearrange your formulas by moving your variables to the other side. So if I move outflows to the left, that becomes a plus. So all I do is outflows is equal to inflows take away net cash flow. You could do it that way. Okay. In which case, our inflows for September are our receipts, 21,770. Our net cash flow is 10,090. Okay, and if you put it through a calculator, that comes out as 11,680. So it's exactly the same. Okay, I think for this particular thing, you get the mark. Yeah, it's a mark for each one. Okay, but it's always a good way of double checking you've got the right answer. Okay, it's always a good way of double checking you got the right answer. Okay, so last one. This is, oh yeah, here we go. This is one is there to trip you up. So what we've got is April forecast. Okay, is it forecast? Yeah, yes. No, it's not a forecast. It's just the net cash flow for April. If you look, we have our opening cash balance. Okay, so in the bank, what they've got is 3,500 cash at the start of April. Then we have receipts in cash. Okay, so this is basically the sales made. We made 1,200. Okay, we have sales due in cash in 60 days. We'll come back to that, 1,100, and our total payment, which is 700. So what we need to do here is use information table 2, calculate the net cash flow for April. Your advice to show you working. So it's 2 marks, I think, for this one. Okay, so we know the net cash flow is equal to cash inflows take away cash outflows. Right. Now, in this particular case, what are our cash inflows? Well, we know we've definitely made 1,200 quid. That is cash. That's receipts made in cash. So it's going to be 1,200. Now, what we've got here is sales. Now, sales is different necessarily from cash, because what we've got here is sales, but it says it's due in cash in 60 days. So what does that mean? That might be an offer. So buy now, pay in 2 months, buy now, pay later. Think about furniture shops, DFS, they have buy now, pay 2022 or something like that. So even though you make a sale, you haven't actually got that money, that cash from the customer yet. So you can't include it in your cash flow for this particular month because you haven't got it. So even though you've made a sale, you haven't had money yet. So you can't include it in a cash flow forecast or as a cash flow table. So in this case, the only cash inflow we've got are those receipts in cash. And we take away our payments, which is 700, and that leaves £500. That's our answer, £500. So a bit of a naughty one there, but that's why that stuff is there in brackets, okay? And the questions, it says calculate the net cash flow for April, okay? So it's got to be very, very careful how you do that, all right? So I think that is all of the questions answered. Some examples I've given you. Now, obviously, there is more detail in there. So if you wanted to look into, do cash flow forecast for a number of months, how you do it rolling over month to month. I'm not going to go into that much detail at the moment. Okay, as I said, we're just going to cover the basics. So give you some sort of tools, some skills, some fundamentals, so you know how to attack these questions in the future. Okay, as per usual, contact me, email me if you've got any questions, or your business studies teacher. Yeah, keep up good work, and I'll speak to you guys soon. Okay, I'm going to end it now. Bye.